This is the Asia Trade. I'm Shery in Tokyo.
I'm Avril Hong in Singapore. The top stories this hour. Caution set to dominate Asian markets as signs of U.S. economic strength have traders trimming bets on imminent Fed rate cuts. We'll be live in Jackson Hole ahead of Chair Jay Powell's much-awaited speech. The Justice Department signaling plans to investigate Fed Governor Lisa Cook over allegations of mortgage fraud, with a top official urging Powell to fire her. And Bloomberg reveals Anthropic is nearing a deal to raise up to $10 billion in one of the largest funding rounds to date for an AI startup.
Take a look at how we're setting up for the Asian market sessions. We, of course, had Japanese stocks losing ground for 3 consecutive sessions. Nikkei futures at the moment not doing much, potentially pointing to a little bit of upside, but we are expecting inflation data out of Japan this hour. We're watching Japanese currency, the yen, also the Chinese yuan. Asian currencies overall under pressure as we saw a rising dollar in the other side of that trade. Take a look at how U.S. futures are setting up because we, of course, had data out of the U.S., including stronger than expected PMI numbers, manufacturing data accelerating at the fastest pace in more than 3 years. On the other side of that equation, there was also more signs of perhaps labor market weakness with jobless claims rising. So a very complicated picture for the Federal Reserve. U.S. futures at the moment gaining a little bit of ground as crude holds steady as well. But Avril, it's really about Chair Powell's speech coming up at Jackson Hole as well.
Absolutely. And ahead of that, we've heard from some other Fed officials as well. The Cleveland Fed President Beth Hammack says she would not support lowering rates if central bankers were making a policy decision tomorrow. And Chicago President Austin Goolsbee told us he hopes a recent spike in services inflation is just a blip.
For sure, it feels to me like it's a live meeting. As you know, before April 2nd, before we got some uncertainties coming on the policy side, I believed that we had pretty stable full employment, that inflation's coming down to target.
Let's go live to Jackson Hole and bring in Bloomberg's Mike McKee. Mike, help us make sense of what these Fed officials are saying, because we've seen how it's playing out in expectations of a September cut that's come down to the lowest level since the weak jobs report.
Well, basically what happened was at the July 30th Fed meeting, almost all Fed officials were more worried about inflation than the labor market. Then we had that bad July payrolls report and the big revisions to the prior months, and people started worrying about whether the economy was slowing down so much that rates needed to be cut. The latest data we've gotten has been sort of inconclusive, and so Fed officials are basically saying we're willing to do whatever's necessary. If we get bad labor market numbers, we're willing to consider cutting rates. If we get an increase in inflation before the next meeting, we're willing to hold. They're all kind of moving to the middle at this point.
What are we expecting in terms of other central bankers adding to the chorus of where policy should go from here?
Well, I think Wall Street is pretty much convinced that, or has convinced itself, that the Fed should probably cut rates. So the question is, does Jay Powell give them any reason to hold on to that optimism, or are they going to sell off after he comes out if he doesn't say we're fixing to cut rates? And that's the hard question to ask at this point. My guess is he's going to say the Fed is keeping its options open because they don't want to get pushed into cutting rates by the markets. So it could be an interesting day tomorrow on Wall Street and on global Wall Street.
Mike, I mean, it's also perhaps worth taking a step back, right? This is Powell's legacy we're talking about. Is he going to leave a hawkish one at his last Jackson Hole as Fed chair?
Well, he doesn't really have a lot of choice about how it's remembered because it depends on who's doing the remembering. It may be that if he signals that the Fed hasn't made up its mind yet, people will consider that hawkish on Wall Street because they've bet on a dovish side. But other economists would probably say he was somewhat dovish and somewhat open to it. So he's just going to do his best and say what he thinks at this point is most appropriate and let history judge. The way he says it, what he wants as his legacy is to turn over the economy in good shape to his successor.
Yeah, and of course, there's a lot of questions about who the successor will be, especially with President Trump really pressuring the Federal Reserve to cut rates, right? I mean, the last that we heard was President Trump asking Fed Governor Cook to resign after the Federal Housing Finance Agency director urged an investigation on her mortgages. But take a listen to what he had to say.
We refer people almost every day. I refer people every week on a minimum to the Department of Justice for mortgage fraud. This is literally what I am required to do underneath the Housing and Economic Recovery Act of 2008, which is to ensure the safety and soundness of the mortgage market. Did she sign these documents? I believe she did sign these documents.
If Governor Cook needs to leave the Federal Reserve, this was really changed the power balance when it comes to the cuts and the hikes in the FOMC.
It probably wouldn't make that much difference in the short run because she has essentially supported the chair, and if the chair wants to cut rates, she would vote to cut rates. So it's not going to be a significant change there. It would give the president more of his own nominees on the board. Whether that would make a short-term difference, too, is unclear. Long-term, it might have more of an effect. But the interesting thing about Mr. Pulte there and his comments is, first of all, if they refer thousands of people's mortgages for fraud, how come he's doing it? You would have your employees doing that. And second, they've only publicly disclosed 3 people, including Lisa Cook, who have been referred, and they're all Democrats. So one wonders if this is a publicity stunt or if there's really anything there. The Department of Justice says they will investigate, and the Department of Justice investigator said she should resign as well, which is kind of odd because they're not supposed to talk about open cases.
Mike, regardless of perhaps what the outcome is going to be from this, those lingering questions still about the pressure the Fed faces regarding independence, what are we expecting to hear? Perhaps some pushback at Jackson Hole?
Well, we'll probably hear from Fed officials and from central bankers from other countries that it is important to have an independent central bank because your economy performs better. They will do what's right for the economy and not what's right for the politicians. Whether that message goes far beyond Jackson Hole isn't clear. It isn't clear how closely Americans are listening to all of this back and forth between the administration and the Fed. People are generally more concerned with when they go to the grocery store, what are prices doing? So we'll see how it turns out, and we'll see if it has any impact. But right now, it's just a lot of noise that the central bankers here and in Europe and in Asia tell us they ignore.
Mike, thank you so much for helping us sort through noise and signal. Great to see you. Bloomberg's Mike McKee live from Jackson Hole in Wyoming. Let's unpack the market impact a bit further with Bloomberg and Life strategist Mark Cranfield joining us in the Singapore studio. So, Mark, the takeaway from the Fed official comments is that September is a live meeting.
I think from an investor's point of view, there's no doubt. They've just heard in the past few hours at least 4 Fed speakers. They may hear more in the coming hours because they're all there at Jackson Hole together. And clearly, they can't agree on this. There's no consensus among the Fed speakers at the moment, which is important from the market's point of view. So they're clearly, and there's time to go. There's still a few weeks until that meeting. So there's time for a lot more opinions to be out there. Plus, whatever Jerome Powell has to say later on Friday, there will then be the weekend situation in America. And typically what investors have got used to over the past few weekends is that there's a bombardment of opinions from outside the central bank about where policy should go and how investors should be thinking. So by the time you get to Monday, things could look completely different than they do tonight. So there is really a lot for investors to digest here. And apart from the official opinions, you've also got the independence of the central bank being questioned as well, as Mike was saying there. So it is a period in which people will be putting higher risk premiums on everything, particularly on things like bonds and the US dollar. They're the ones that are most likely to be reflecting this change of status in terms of how people view the United States as an investment place. Equity market is in a little bit of a different space. They've still got to deal with other issues such as Nvidia next week as well. But certainly bonds and the dollar can expect a pretty choppy period next week as people try to play out the scenarios for whether there's going to be a rate cut, how big a rate cut there's going to be, how quickly it's going to come. All of those things are in play for the next couple of weeks.
And the issue also is that even come Monday, we might not see fully that repricing because of the markets being closed. So what is the most likely outcome you're seeing in the ensuing post-Jackson Hole?
People will have to be very dynamic in the way that they handle their risks in the coming days. You've got a typically quiet period in terms of liquidity. Is that the week leading up to Labor Day is usually one of the most illiquid in American markets. There's also a UK public holiday as well thrown in there just to add into the mix. So it's a tricky time. People would probably prefer not to be carrying large positions in that week. But the fact that Jackson Hole comes here and there's a divergence of opinions probably means they're hanging on to some risk that they usually wouldn't do so. So that will add, particularly on Monday, that's when a lot of people will be reassessing whether they want to really hold these things through to the Fed meeting or whether they want to dump some of their exposure. So we can be in for some pretty big knee-jerk reactions in the market in that period. So very difficult one. Bond people especially, we're looking at the curve to see whether it justifies steepening even further. So all in all, not an easy time to be an investor.
Yeah, on the bond space here, when it comes to the JGB's 20-year yield now rising to the highest since 1999. So what will be the dynamics, especially in Japan, as the BOJ Governor Ueda is also in Jackson Hole?
It's a great opportunity for him to probably, if he really wants to try and get an interest rate hike in before the end of this year, which appears to be his objective. He's just looking for the right window. He's been given a great opportunity here because US Treasury Secretary Scott Bessent has declared publicly that the Bank of Japan is behind the curve. That's a great chance for Ueda to step in here and use a foreign entity as his leverage to go ahead with a rate hike back at home. So here he is. Typically, central bankers sound a little bit more open when they're on foreign soil than they do at home. He's very guarded when he's speaking before the press and the public in Japan. He really watches his words very carefully. Here he is at Jackson Hole, a chance to relax a bit more and maybe be a bit clearer on when he thinks it's time. We've got Japanese CPI coming up later this morning as well. It's probably going to show once again inflation still running about 3%. Japan, I think nobody disagrees. They're behind the curve in terms of raising interest rates. Here's his opportunity to say, I want to get on with it. Whether it can be for the September meeting, maybe too early. Odds at the moment are a coin toss for October. He can probably push those odds towards fully pricing a rate hike for October. That may well be his objective this weekend.
Will it be able to move the yen? It's been pretty range bound.
Well, this is a chance for people who've been waiting for the time to... The yen looks relatively undervalued, and if Ueda does sound a bit more hawkish than expected, that would certainly play out in the yen, particularly on cross rates. If you look at the way it's moved against the Australian dollar, the euro, the pound, it looks as though people are lining up here to look at the yen as a relative value play. And if they see the chance for higher interest rates in the near term, that certainly adds weight to the case for people that want to buy the yen.
Mark, really good to get your analysis. Thank you so much. Bloomberg M9 strategist Mark Cranfield. More ahead on the Asia trade. This is Bloomberg. Let's check in on how U.S. Treasury futures are faring, of course, as we wait with bated breath on what Powell will say at Jackson Hole. We already saw that caution creeping in ahead of this. The entire Treasury curve shifted higher. Treasuries fell as traders paired bets of what we could see from the September meeting about a potential for a rate cut. And as some of our strategists have been highlighting, it's really also about this curve steepener trade potentially. Now, the Kansas City Fed President Jeffrey Schmid says American businesses are showing renewed optimism that's filtering through to the labor market and putting the focus back on inflation. Schmid spoke with us from Jackson Hole about the economy and growing political pressure on the Fed.
I'm a little philosophical about the whole conversation of Fed independence and where our role is in the American economy. We're almost 250 years old as a nation. I think there's something to be said. We were built on words, and we continue to debate those words legislatively and judicially. Whatever friction we might have with other branches of the government, I think great steel's tested by fire. So we can always be better. We can always do this better. But I think the nature of independence, and I think, don't believe me, believe other nations that have central banks and don't. It seems to work, but I'm always open for the conversation of how do we make it better.
Well, the big question for everybody, especially for Wall Street, is what happens on September 17th?
So this is, as you know, kind of an interesting month because we've got Jackson Hole and then we've got quite a few weeks of data to kind of pull in. So I'm really, I think everybody's quite interested in some of maybe the prints that happened in the last couple months and kind of where they go from here. So I'm like everybody. I think there was some fascinating conversations at the last FOMC. As you know, there were a couple of dissents. I think my interpretation of what's happening, especially in the labor market, is that the first couple quarters, a lot of business people were just saying there's uncertainty enough, and I think they kind of cooled a little bit on the higher side. But the most recent couple weeks that we've been talking to businesses in the district, there seems to be a burgeoning optimism again, that they've kind of digested and they've been agile enough to try to work their way through some of the new policies from the administration, and maybe going forward, maybe we'll see a little bit of uptick. That said, I still believe that the inflation number is trending closer to 3 than 2.
Well, we saw that in the minutes that, in general, the Open Market Committee felt that inflation was a bigger danger at this point. Would you say that's your view now?
It would be my view now. I think with an understanding that what may have happened in the first couple quarters on the labor side, which I think concerned several people on the committee, me included. But I think this PPI was interesting, that print was interesting, but I really believe that when we talk to a lot of folks in our district, is that if you had to kind of lean or have a bias toward, it would be on the inflation side.
Kansas City Fed President Jeffrey Schmid speaking with our colleague Michael McKee at Jackson Hole. And another sector that we've been watching, the hot private credit market, worth $1.7 trillion. And April, of course, we know that so far there isn't necessarily a universal definition of what a private credit default could look like, but analysts are now sounding the alarm that they could be in the range of around 2 to 3%. In fact, private companies have been able to keep payment defaults in check through payment-in-kind arrangements that allow borrowers to defer cash interest payments until debt comes due, leaving them with one big bill at the end. But if you include those selective defaults, you can see that line in white is much higher as well.
Yeah, I mean, it's really interesting how this hot market, as you say, is indicating perhaps these underappreciated risks that even the private credit firms that have been known to give a bit more wiggle room are also flagging some of these risks for borrowers potentially when these times are tough. And I think it also speaks to how much capital has just come into this market, right? We had the likes of, I think, JP Morgan talking about how it shows inflows, too much capital was committed far too quickly. Now, it's still worth noting that we're still seeing that returns for the private credit market really attractive, above 8%, right? So that's still luring investment, though it's not quite the cash magnet that it once was, Shery.
Yeah, I think the lower borrowing costs given some optimism that perhaps this market is still intact, at least for the time being. But as you said, it's the transparency and really the potential of more risks ahead, something that we'll be watching very closely. We have more ahead on the Asia Trade. This is Bloomberg.
are some of the stories we're following. The US and the EU have outlined plans that could reduce tariffs on European cars to 15% within weeks and potentially offer discounts on steel and aluminium. The joint statement also includes commitments to cooperate on economic security, food standards, and digital trade. White House trade advisor Peter Navarro credits the breakthrough in Ukraine talks for paving the way to the deal.
I can think of no deal more important than with the European Union. This is like a really important mountain to climb, and we climbed that. And President Trump got up to the top of the mountain today. In many ways, the Ukraine situation has been a total wake-up call for Europe.
President Trump has hinted that he is open to Ukraine launching more attacks on Russia as the White House seeks to pressure President Putin into a meeting with Ukraine's leader. In a Truth Social post, Trump wrote that it is hard to win a war without attacking the invader's country. He later told Newsmax we'll know in about 2 weeks whether peace can be achieved. The Kremlin has so far remained non-committal on any summit with Ukraine's president. Secretary of State Marco Rubio says the U.S. will immediately pause issuing worker visas for commercial truck drivers. In a post on X, he says the increasing number of foreign drivers operating large tractor-trailer trucks on U.S. roads is endangering American lives and undercutting the livelihoods of American truckers. A New York appeals court has struck down a $464 million penalty against President Trump and his company. The panel upheld findings that Trump inflated asset values but called the fine excessive. Attorney General Letitia James says her office will challenge the ruling. The decision eases Trump's legal troubles, adding to other cases dropped since his re-election. And President Trump has visited a police facility in Washington, D.C., thanking federal officers deployed under his control and saying they'll remain in the city for a while. Trump had earlier told a radio show he would be going on patrol in a secret trip with police and military. The stunt has returned focus to his controversial move last week to surge U.S. officers and troops into the nation's capital.
Hey, we'll take a look at how we're setting up for the Asian market opens. We are awaiting inflation data out of Japan to come just at the bottom of the hour. You're seeing U.S. futures now pointing to upside after 5 sessions of losses for Wall Street. Of course, ahead of Chair Powell's speech, there's a lot of caution. Not to mention that Jackson Hole is not just the big market risk, but maybe next week could be worse. We're seeing, of course, August jobs report released in early September risk. We have summer liquidity issues with U.S. and U.K. holidays. Nvidia also reporting next week. You can see Sydney futures down 0.1% as we're seeing a little bit of strength for the U.S. dollar. More ahead, this is Bloomberg. Breaking news out of Japan, we are getting the core CPI numbers coming in above market expectations, growing 3.1% year-on-year for the month of July. When you take out core food, also energy prices is a gain of 3.4% year-on-year for the headline number to come in at 3.1% year-on-year, which is in line with estimates. But of course, it's always the core CPI numbers that we care about, and that's coming in above economists' expectations and, of course, very much above the BOJ's policy target as well of 2%. We have continued to see the acceleration in Japanese inflation, making it much tougher for the Bank of Japan when it comes to hiking interest rates in order to really put a dampener on this inflation trend at the same time when you have tariff uncertainty and economic uncertainty. Take a look at how bonds have been trading, because we have seen, of course, JGB yields continuing to surge higher. The 20-year JGB yield rising to the highest since 1999 already. The 10-year yield around levels that we haven't seen since 2008. The 30-year yield also very close to record highs. These high yields when it comes to the long end for global bond markets has been the trend. Of course, Treasury yields have also been higher after stronger than expected manufacturing and factoring data in the U.S. Let's get more perspective on the outlook for the U.S. economy and Fed policy as well. Joining us from Jackson Hole is Sebnem Kalemli-Ozcan Brown University economics professor professor and director of the Global Linkages Lab. Sebnem, always great to have you with us. How tricky of a messaging act does Chair Powell have on his plate this week?
Hi, Sharon. It's great to be back on your show. Indeed, I think this is going to be a very delicate balancing act in terms of messaging coming out of the Fed. Tariff is a stagflationary shock, so the dual mandate of the Fed is coming into tension. We started seeing this already in the data with higher producer price numbers and also some softening in the labor market. I think it is going to be a difficult time and difficult road ahead.
Do you expect the Federal Reserve to cut in September, and should they?
I don't think they should, because I think inflation is right now a bigger risk than the labor market. This is my opinion, and the work we did at Global Linkages Lab, Brown University, confirms this. We estimated the impact of tariffs both on inflation and unemployment, and right now what is happening in real life data is exactly as our model estimates, because this is all about supply chains, and it's all about higher cost of doing business. So it is going to start with higher producer prices, higher cost to firms, and then it is going to pass to consumers. This is going to take time. It didn't happen so far because, of course, there were inventories, the orders were before. But if you go down the street and start talking to firms, which is what we do at Global Linkages Lab, we use firm-level data on supply chains and our model based on that, then you realize how serious this is going to be. For example, a major flooring supplier to commercial and residential construction real estate in the United States is going to increase prices 8% starting orders in September. On every country that now faces a reciprocal tariff over 10% when they buy their supplies from those countries. So we have to watch out the September numbers. I think they are going to be important. And then going forward, I think we are going to see more and more this on the inflation side coming through producer prices, supply chains, and firms' pricing.
Sebnem, you raise a good point that the equation could be more tilted towards the inflation side of things. But can you help us understand, because a number of economists had been flagging that by now we would have seen the inflationary impacts. Why is it taking a while for the pass-through to be witnessed?
Yes, of course, because again, that type of thinking starts from the observation that U.S. is actually not a very open country, right? Why? Because imports are not a big share of GDP, around 10 to 12%, compared to a country like Ireland or Singapore or Brazil, South Africa. You would say U.S. is not that an open country. So if I put a tariff, say 5 to 10% on imports, that wouldn't have that big of an inflationary impact on the U.S. That's kind of the starting point. But I would say this type of thinking is very middle-aged, and it doesn't work in today's globalized world, because today's globalized world is about supply chains, about trade in inputs, not necessarily only trade in final goods. So even you are, in that sense, not a large importer, and in terms of your final goods like the U.S., you buy a lot of raw materials and inputs and products for your own manufacturing production, and also for your own other services production, other sectors in the United States. So the inflationary impact then is going to come through that production side, that supply chain side, which is, of course, the standard thinking that doesn't take into account the globalized world we are living in is going to miss, because that thinking is going to say, well, we don't import that much, so, if we don't do very high tariffs, we are going to get by. Also, the tariffs are ending up pretty high. Yes, maybe we are not putting tariffs like 30, 40, 50%. We are now celebrating, 15% of Europe. But make no mistake. I mean, 15% tariff on European Union is a pretty large number. So I don't think it is right to think this as, oh, we didn't get 30%, we got 15%, so we are lucky. No, 15% is much higher than 10%. And if you start adding up all these tariffs, United States now has an effective tariff rate over 10%. Coming from a 2%. So at the beginning of 2025, we had a 2% tariff rate. Now we are climbing to a almost 15% tariff rate. And in a world where in the United States we buy a lot of our inputs, that's going to have an inflationary impact for sure.
Sebnem, as we wait to see potentially higher inflation, you talked about some of the sectors you've been speaking to on the ground. You talked about builders. Where else are we likely to see that incremental price pressure? Because we have seen how U.S. retailers, for the moment, they do seem quite hesitant to pass on those costs to consumers.
True, and then it's going to come a lot to that. But I think sectors such as not only construction, but also wholesale, retail, these are the sectors to watch. And after that, also, pharmaceuticals, steel and aluminum, because administration also announced that there will be more sectoral tariffs down the road. And they are going to be very dangerous. For example, we already heard from Walmart and Home Depot, right? They were trying to keep it under control so far, but there were two reasons for that. One is the inventories, and the other one is consumer demand stays strong. If we also start seeing now the consumer demand being weakening, and inventory story is now out, even you want to replenish your inventories, that's going to be at the new higher price. So that means even those guys, those large guys like Walmart and Home Depot, they cannot keep this up under the rug anymore. They are going to start passing it to not only to the distribution, there's another sector, but also consumers. So now the big question is, of course, how much is going to be this passed through? The academic literature is conflicted on this. There are papers showing the pass-through is very high, and there are papers showing it is not that high. But nevertheless, this doesn't change the fact that we are going to have inflation coming simply from the fact that we are importing a lot of inputs in our production in America. And there's also the other side of the stagflationary impulse. I told you tariff is a stagflationary impulse, right? And that's going to be on the employment side, because the firms, again, this goes back to firms. If firms are now seeing this, okay, my costs are higher, my cost of doing business is higher, then maybe I have to also think about hiring new workers, right? Maybe then I need to fire some workers. So it is also going to hurt workers and employment at some point.
Sebnem, always good to have you with us. Sebnem Kalemli-Ozcan, Brown University Professor of Economics and Director of Global Linkages Lab, joining us there from Jackson Hole. We continue to watch Japanese assets. Of course, we got the inflation number out of Japan. Core inflation rising 3.1% year on year, which was above economists' expectations, but slowing down a little bit from the previous month. The national headline CPI also growth of 3.1%. Of course, very consequential as we talk about central banks and what the Bank of Japan Governor Ueda will do. He's also at Jackson Hole. We will be watching for any commentary on the direction of Japanese monetary policy. As Nikkei futures at the moment not doing much after 3 sessions of losses already, but we're watching the Japanese yen because it strengthened slightly against the U.S. dollar after we saw the inflation numbers in Japan still come in above 3%. We have more ahead on the Asia trade. This is Bloomberg.
Given the right to build electric plants, they become almost like a public utility because we have old grids. We have a lot of stuff that's old. We wouldn't be able to compete with China AI. And now we're totally leading the AI race and the artificial intelligence. It's a big deal. And it's the hottest thing there is for probably in 35, 40 years. It's a lot of people don't know what it is. Just trust me, it's very hot. It's big.
President Trump there speaking in Washington. Now, Bloomberg has learned that Anthropic is nearing a deal to raise as much as $10 billion in new funding, one of the largest rounds ever for an AI startup. Let's bring in Bloomberg tech reporter Annabelle Jolis for more on this group. So, Belle, it looks like what's potentially being raised might be more than expected. What do we know?
Yeah, I mean, that's exactly it. It's a higher than expected sum. That's what we're hearing from sources. So at the end of July, Bloomberg News was saying that Anthropic was in advanced discussions to raise up to $5 billion in a round that would have valued it at $170 billion. The amount, though, does appear, or what we're hearing is that the amount has increased significantly given very strong investor demand. So $10 billion, as you said, it actually would be one of the largest mega rounds that we've ever seen for an AI startup. The discussions, of course, they are ongoing. Again, according to our sources, that final amount could change, but certainly it would cement Anthropic as one of the world's leading AI developers, and of course very important given you've got President Trump, and we just heard in that soundbite there saying that the US, I mean, that's his view that they're leading the AI race, but it's certainly a very big contest between the US and China right now.
Any ideas right now how the funds will be used?
Yeah, what we understand from sources is that it's going to be, again, used to fuel that competition more domestically. Anthropic is up against the likes of OpenAI, for instance, Elon Musk's xAI. Each of those have, of course, raised billions of dollars this year to try and finance their own investments in data centers and talent for building AI models. Just some context as well on Anthropic, because it was actually founded in 2021 from previous OpenAI employees, but it has certainly been positioning itself as sort of a reliable, a safety-conscious firm that users can trust. In terms of who's leading this round, what we understand from sources that it's at IonQ Capital. Other expected participants could be TPG, Lightspeed, Spark Capital, Menlo as well. That's, again, according to sources familiar with the matter. But we do understand Anthropic is also in discussions with some sovereign wealth funds, including in Qatar and Singapore, that can often be a little bit more deep-pocketed.
Bloomberg's Annabelle Jewelers there with the latest on Anthropic. Bloomberg also learning that Boeing is closer to finalizing a deal to sell as many as 500 aircraft to China. The deal is contingent on defusing the trade hostilities that go back to Trump's first term in office. Let's bring in our China correspondent, Min Lo. Now, this is expected to be a centerpiece of any trade agreement between China and the U.S.
Yes, for sure. I mean, planes are as expensive as skyscrapers, and this deal would go some way to reduce the trade imbalance between the two sides. It would be beneficial for both Trump and Xi, and as you said, it would put an end to this sales drought that we had seen since 2017 during Trump's last visit to China. That was when both sides had agreed to this big $37 billion deal, China agreeing to buy about 300 jet planes. But you can see on this chart that since 2019, we have seen a sharp drop in the number of orders for Boeing from China, really coinciding with the souring relations between the two sides. So yes, for now, we understand that the Chinese government has been talking to Chinese airlines to find out how many aircrafts they would need. And Boeing is in talks to work out the terms of this mega deal, working out the delivery timeline, the volume and types of aircrafts that China might want.
Min, this is also coming at the time when China is trying to build up or become a bigger player when it comes to the homegrown plane-making capabilities. Does this potentially imply something for their efforts?
Yeah, it does for sure mean that China's own homegrown plane-making capabilities, it's not be able to ramp up as fast as it wants to, right? Because right now, this Boeing deal is coming on the heels of another deal that we just reported a couple of days ago. China also in talks with Airbus, also looking to buy around 500 aircrafts. So in total, 500 plus 500, there's 1,000 aircrafts from this Boeing and Airbus deal. It would double the number of aircrafts that China currently has. Of course, that's a volume of aircrafts that its homegrown plane maker, COMAC, will not be able to keep up with. So China is still quite reliant at this point on Western industrial technology. And this deal, if it comes through, it would help China secure a very hard-to-get sort of delivery slot, given that both Boeing and Airbus are pretty much sold out until the 2030s. But as you said, Shery, earlier, a lot also hinges upon how trade tensions are being resolved between China and the U.S. We know that trade talks have been ongoing. They haven't managed to reach an agreement, but this will likely become the centerpiece of any trade agreement between the two sides.
Min Min, thank you so much. Bloomberg's China correspondent Min Min Lo. Now, when we talk about rivalry between the U.S. and China, not just about planes or AI, smartphone giant in the meantime, Xiaomi, has succeeded where Apple failed by launching its own electric car. The dramatic pivot has helped the Chinese company gain some $120 billion in market value over the past year. Bloomberg Originals has been looking at Xiaomi's push into the EV sector. Here's a preview.
Giant has a connected ecosystem of products, a devoted fan base, and is constantly innovating. If you're in the US, you may say Apple, but in China, it's Xiaomi.
It's this consistent marketing to the younger consumers in China that has cultivated kind of a cult following.
For many consumers in China, Xiaomi is Apple, is Tesla, is Google.
Now, Xiaomi has managed what Apple failed to do: build a car.
Xiaomi shares have touched a record high after strong initial orders for its new $35,000 SUV.
So within 3 years, they managed to set up this very complicated supply chain in China and essentially churn out these incredibly popular cars.
Profits have jumped as customers rush to the company's latest offerings. But succeeding in the world's most crowded EV market isn't easy.
Competition is really fierce right now.
Growth will mean turning Xiaomi into a global brand. And this is no easy task when the world's biggest economy is effectively off limits because of trade barriers. Yet, Chinese companies are already tapping markets beyond the US. So, is Xiaomi on easy street? Or will it be a bumpy road to success?
Subscribers can watch that documentary in full right now on the terminal and on Bloomberg.com, and it'll also be up on the Bloomberg Originals YouTube channel a little bit later. We have more ahead. This is Bloomberg.
Technology is developing so fast.
My belief is that the humanoid robotics will not only build the biggest business we've ever seen by many multiples, but it's going to be also the biggest product launch we've ever had.
We aim to reach an annual delivery volume of over 10,000 robots within the next 4 years.
This year we are building about 2,000 robots, and next year we plan to build over 10,000 robots.
Prototype is easy, but mass production is difficult. To make them reliable, can work for a long time without maintenance, it's not easy.
We're seeing like the robots are getting smarter these days. They're better explaining themselves. And the magic ingredient is, of course, about the AI.
Whatever AI produced could be deployed in the robotics. That's true.
I think it's the best time to be entrepreneurs in China.
I think the whole world is seeing the opportunity for this new generation of robots to expand significantly. And so I think there's just a lot of promise in this industry right now.
Now, this new surge of AI breakthroughs across Asia pushing those humanoid robots closer to reality, but not everyone's convinced the future is here just yet. Many say the technology is impressive, but not yet commercially viable. Bloomberg opinion columnist Thorbecke joins us now with more, and really, I'm not surprised, and I share your skepticism because we've seen these humanoids trying to run marathons, trying to box, and trying to play football. They look pretty funny, expensive toys.
Yes.
Do they have a future?
That's right, Shery. So, I think there's been a lot of hype and a lot of propaganda really sustaining the humanoid robot industry in China. But the reality is it's much more difficult to, get a robot to sort of fold your laundry than it is to get it to dance on stage for a few minutes. And I think a lot of the excitement has been propelled by AI advances. But the amount of training and data it takes to get a physical robot to navigate the very unpredictable and messy physical world is way different than, getting a chatbot to understand text like a human being. So I think there's still a lot of technical barriers. And I think that quick reality check aside, they do have in the long-term potential to really transform the economy, but I don't think they're quite ready for prime time just yet.
So, Catherine, given how some of these companies might not be ready in a very intense competitive space, are we expecting to see a lot of these companies just not surviving?
Right. So I think we're going to see sort of a humanoid Hunger Games. And, one of my big takeaways from this World AI conference I attended in Shanghai last month was just how intense the competition is right now. I've just never seen so many robots in one place at one time. And it was kind of remarkable. And I think it's a double-edged sword. I think that really drives innovation in the broader ecosystem. But at the same time, I think the reality is that, in the next 5 to 10 years, not all of these humanoid robot makers will exist.
Can these robots be companions as well?
So that was a big debate that came up over and over. Do we want these robots to be tools or do we want them to be our friends, our companions? And I think ultimately, as fun as the idea of a robot buddy is, and I think a lot of the ones that have been getting a lot of attention are just the ones that look very human-like, and people are really amazed at how human-like they can get. But I think the ones that'll make the biggest difference are the ones that can actually do, real work and repetitive tasks and really make an impact on companies' bottom lines. And ultimately, I think that's a good thing because then we can spend more time being humans.
Catherine Thorbecke, Bloomberg opinion columnist here with the latest on what to expect from this humanoid race. And in fact, we'll have more of this story when we come back with Bloomberg Tech Asia in the next hour. That's at 8:30 if you're watching in Hong Kong and New York, 9:30 a.m. in Tokyo. And these are some of the stocks that we'll be watching when trading starts in Japan and South Korea. Keep an eye on bank stocks in Japan after the country's core CPI came in above forecast, and with BOJ Governor Ueda set to speak at Jackson Hole, traders now on the lookout for hints of the BOJ's next move. We, of course, have seen JGB yields now at the highest level in decades, the 10-year yield at a 2008 high. This is Bloomberg. This is the Asia Trade. We're counting down to Asia's major market opens, and really ahead of Fed Chair Powell's speech at Jackson Hole. Of course, April, we have seen some conflicting data out of the U.S., including stronger than expected factory numbers. So what that means for the inflationary picture in the United States is a key question, and what happens to September's rate cut, another question.
Yeah, complicated backdrop. If the Fed wants to be data dependent, think about how even jobless claims, right, are telling us something quite different, even though broad-based PMIs rose. So really, the Fed has their work cut out for them coming up, Shery.
And of course, the Bank of Japan Governor Ueda also in Jackson Hole. And we have seen those inflation numbers here in Japan already surprising to the upside, growth of 3.1% year on year for the month of July. That actually led to a little bit of a pop for the Japanese yen that's now at that 148 level after weakening in the overnight session against the U.S. dollar. Nikkei stocks also up about 0.1%. We have already seen 3 sessions of losses for Japanese stocks, so we're reversing that a little bit. But what we're watching is the 10-year yield as well, because it's now at around those 2008-year highs. Not to mention that we have seen the 30-year yield also reaching almost record highs. The 20-year yield also at levels that we haven't seen in decades. And all of this coming at a time when there are also fiscal concerns to contend with. Take a look at how South Korea is coming online, because we saw Korean stocks gaining ground for the first session in 4 days. And right now, gains of 0.8%, as the Korean won is holding steady at that 1,400 level against the U.S. dollar. Of course, we're watching geopolitics in South Korea. We're watching the trade deal with the United States, as well as President Lee Jae-myung is in Japan this weekend and headed for a summit with President Trump next week.
Yeah, Shery, I think it's worth noting that even though the likes of the U.S. and EU have sort of moved towards formalizing their trade pact, Japan, South Korea, we still have some of those lingering question marks. And the stock market moves in the region this week. We've been seeing how Asia stocks continued their slide on the region's benchmark for 4 sessions now. And will it be a 5th? And even after Jackson Hole, do we get more clarity? Think about how those liquidity constraints might continue weighing falling. Worth noting, the ASX 200 was the outperformer just a day ago, adding a little at the moment. You are seeing a bit more firmness in treasuries against the backdrop of a day ago. Treasuries falling as traders trim those rate cut bets for the moment. Treasuries, both 2 years, 10 years, ticking a little higher and looking quite firm on the Aussie dollar as well, keeping watch on Brent after a Trump administration official talked about the pressure of India's imports on Russian crude, so ramping up the scrutiny there. Now let's bring in our next guest, who says there's a distinct probability that the Fed may not cut rates this year, depending on the data. With us now is Pooja Malik, partner at Nipun Capital. Pooja, really good to see you. What is your sense of, as we've seen these momentum trades unwinding, do we see them creep back in next week?
The momentum trade unwind is related to investors taking some profits given where markets are. The U.S. market, for example, has gone up over 1,000 points in the last 12 to 18 months. Emerging markets are up about 20%, and then the markets like Korea that you were just talking about are actually up close to 40% for the year. So the momentum unwind has to do with investors taking profits at a time when uncertainty is high, given that the Fed decision is going to come out between now and September. So the momentum unwind definitely related to profit taking ahead of uncertainty. Will that come back? Yes, there are lots of momentum traders in the market, and I do think it will come back later in the year, but probably not till the Fed cut decision is done.
Which market do you think is most underpricing the tariff risk here?
In my opinion, India is the one where the tariff risk is very high and not being priced in. And remember that in India, the tariff risk has to do with goods, but also with the oil exports. So that's the second set of tariffs, which is scheduled to kick in on August 27th. India still got, very high exposure to oil imports coming from Russia, and they have benefited from the drop in oil prices. But nevertheless, the hike there would ripple through the economy at a time when earnings are weak already. So in India, for the last 5 quarters, earnings growth has been at single digits, but the market's pricing in almost a 15 to 20% earnings growth. So that is the country where I see the most risk in terms of tariffs and its impact on earnings.
And Pooja, as we're speaking, we're getting some headlines on the Bloomberg coming from the information saying that Nvidia now has ordered a suspension to H20 chip production. It's told some of its component suppliers to suspend production work related to the H20 chip tailor-made for the Chinese market. This is according to 2 people speaking to the information that the directive comes after weeks of the Chinese government telling local tech companies to stop buying the chips due to alleged security concerns. But Pooja, of course, we do have Nvidia earnings next week, at a week that we also have the U.S. market, the U.K. markets going on holidays. We're also headed towards the August jobs report. So how much of a risk could all of this be for the markets?
The Nvidia earnings is definitely a big risk to the market, not just in terms of what it means for Nvidia, but the investor sentiment impact it has across the U.S., across the tech supply chain, and across emerging markets. I think one of the areas of the markets that's going to prove to be more resilient is China, because they have been supporting the domestic sector in terms of AI, semiconductor, and technology. But if you look at other markets, the one that is really vulnerable at this point is Korea, because it's had a huge run-up, and most of that run-up has had to do with positive ripple effects from Nvidia, semiconductors, etc. So a give back there would, I think, impact investor sentiment in Korea much more so than in China, for example.
Tell us a little bit more about the Chinese market, because there was a lot of optimism over the tech sector with the breakthrough from DeepSeek earlier in the year. Where are we at now?
It's interesting. In China, the economic situation is definitely poor. And if you look at some of the recent numbers that came out in July, the industrial production, the fixed asset investment, retail sales, as well as property, all numbers were down. So the macro situation in China is very tough right now. Nevertheless, investors are interpreting that as a sign that there will be more and more policy stimulus to offset that. So markets have done really well. China is up about 40% in the last 12 months, about 20% year to date, with China's small caps leading the rally. And that rally, while it did, it started around the DeepSeek point, but a lot of that has come from policy stimulus. So the Chinese government has changed regulation around requiring insurance companies and mutual funds to invest more in equities. And that was the first leg in. As institutional investors bought more equities, it supported prices. We are now seeing a second wave of retail investors come back into the market in a huge way. So definitely policy support has been pivotal to what's going on in China, despite the fact that the macroeconomic situation is very weak.
So Pooja, at the end of the day, would you say that there is that potential for Chinese outperformance versus the rest of the region in the second half of the year?
There still is. And again, that relates more to the stimulus. So China has now finally embarked on another set of measures to support property prices. Property prices are 40%, or property is 40% of the GDP there. And property prices also have a wealth effect. Consumers feel rich when their property is doing well, even if they're not selling it. So that consumer sentiment finds a lot of support from property prices. The government just instituted a set of new measures to support property prices, including outright buying of distressed properties. And as that happens, I think that's going to be one big sort of support that could drive consumer sentiment, investor sentiment, and could drive markets higher. And then besides that, for the first time, we're also seeing the government actually support end demand through giving interest rate subsidies on consumer consumption loans, providing free education in sort of the elementary school level, and now even talking about Social Security for lower wage earners. So I think there's still a lot more policy support to come, and that could drive the market higher in China.
Pooja, thank you. Really appreciate your insights. Pooja Malik is partner at Nipun Capital. Now, even as we focus on the Chinese consumer and policy making, turning our attention to the U.S. as well, Kansas City Fed President Jeffrey Schmid says American businesses are showing renewed optimism that's filtering through to the labor market and putting the focus back on inflation. Schmid spoke with us from Jackson Hole about the economy and growing political pressure on the Fed.
I'm a little philosophical about the whole conversation of Fed independence and where our role is in the American economy. We're almost 250 years old as a nation. I think there's something to be said. We were built on words, and we continue to debate those words legislatively and judicially. Whatever friction we might have with other branches of the government, I think great steel's tested by fire. So we can always be better. We can always do this better. But I think the nature of independence, and I think, don't believe me, believe other nations that have central banks and don't. It seems to work, but I'm always open for the conversation of how do we make it better.
Well, the big question for everybody, especially for Wall Street, is what happens on September 17th?
So this is, as you know, kind of an interesting month because we've got Jackson Hole and then we've got quite a few weeks of data to kind of pull in. So I'm really, I think everybody's quite interested in some of maybe the prints that happened in the last couple months and kind of where they go from here. So I'm like everybody. I think there was some fascinating conversations at the last FOMC. As you know, there were a couple of dissents. I think my interpretation of what's happening, especially in the labor market, is that the first couple quarters, a lot of business people were just saying there's uncertainty enough, and I think they kind of cooled a little bit on the higher side. But the most recent couple weeks that we've been talking to businesses in the district, there seems to be a burgeoning optimism again, that they've kind of digested and they've been agile enough to try to work their way through some of the new policies from the administration, and maybe going forward, maybe we'll see a little bit of uptick. That said, I still believe that the inflation number is trending closer to 3 than 2.
Well, we saw that in the minutes that, in general, the Open Market Committee felt that inflation was a bigger danger at this point. Would you say that's your view now?
It would be my view now. I think with an understanding that what may have happened in the first couple quarters on the labor side, which I think concerned several people on the committee, me included, But I think this PPI was interesting. That print was interesting. But I really believe that when we talk to a lot of folks in our district, is that if you had to kind of lean or have a bias toward, it would be on the inflation side.
Kansas City Fed President Jeffrey Schmid speaking with our colleague Michael McKee at Jackson Hole. And of course, the breaking news that we've gotten in the past couple of minutes is really how the information is reporting that Nvidia has ordered the suspension to its H20 chip production. It's told its suppliers to suspend any H20 related work. And of course, this is the chip that's the most sophisticated one in the AI sphere that Nvidia has been allowed to sell in China. We know how the U.S. administration effectively banned its sale to China earlier this year and then reversed that decision. We're keeping close tabs on Nvidia suppliers in the Asia session today. Shery.
And we're also watching banks here in Japan. The Thorbecke Banks Index also at the highest level in about a week or so. And you can see the broad upside and just a sea of green. Of course, we continue to have JGB yields rising to the 20-year yield, rising to the highest since 1999. We continue to get those fiscal concerns after the upper house election and the ruling coalition losing its majority of last month's vote. The 10-year yield around the highest since 2008, 30-year yield also around the highest ever. So we are now seeing that upside when it comes to these financial stocks. More ahead. This is Bloomberg. We're watching chip stocks across the Asia session. Of course, we have heard from the information that Nvidia has told some of its component suppliers to suspend production work related to the H20. This would be the chip tailor-made for the Chinese market, and people speaking to the information saying that the directive comes weeks after the Chinese government told local tech companies to stop buying the chips due to that alleged security concern. And of course, a signal that although the Trump administration might be allowing Nvidia to resume selling the chips, this may really turn the dynamic in the Chinese market as the geopolitical rivalry between the two countries continues. Is a little bit of a mixed picture right there. Let's bring in Bloomberg tech reporter Annabelle Jewelers for more. So what do we know at this point when it comes to Nvidia?
Yeah, this is a really major development this morning that we've got from the information, as you said. So the H20, this is the chip that was designed specifically for the mainland market in China. It was halted earlier. That was resumed, or sales were allowed to resume about a month ago. This morning, though, what we've got is a production halt. What is interesting, though, is that it's not coming from the U.S. side, it's coming from the Chinese side instead, or it's a result of Chinese government policies. So it tells you very much that Nvidia's hopes of maintaining that foothold in the Chinese market do remain in limbo right now. So what the information is, again, previously reported as well, is that the fear here from Chinese authorities is that Nvidia's chips could contain backdoors that funnel sensitive information or sensitive data from China to the US. That's their biggest concern. The Nvidia chips, the H20 chips, are going to allow for data or information to be transferred from China to the US. As a result, the information has said that's why China is asking companies, or the government rather, is asking companies in China to not purchase H20 products. And this is why that production halt has now apparently come into effect, again, according to the information here.
Bell, this also puts Nvidia suppliers in the spotlight. They're caught up in the middle of this. It's interesting, though. We're seeing how some of these Korean suppliers like Samsung Electronics, they're actually higher in trade today.
Yeah, I mean, it's kind of difficult to judge the sentiment off that as well, given that we have really seen a lot of mixed moves for tech and a lot of downward pressure over the past few sessions. But generally, I mean, they are very much caught up in this because Samsung, for instance, that you mentioned, it does supply HBM chips to the H20 production lines. You also have Amkor, for instance, that does advanced packaging of the H20 chips. Again, the information here has said that both of these companies have been informed to halt their productions. this is another sign to us as well that Nvidia is really caught up in these geopolitical tensions, like you mentioned, Shery, between the US and China. This reversal on the ban came from the Trump administration. We had initially seen sort of a buying spree from Chinese firms, or that was what was reported again by the information, that there had been a flurry of orders, around 700,000 H20 chips ordered in just the first few weeks after that ban was lifted. But again, this halt does appear to have come through from Beijing, and it appears that firms are heeding as well that advice.
Bloomberg tech reporter Annabelle Drillers with that breaking news on Nvidia. Let's turn to geopolitics, because President Trump has hinted that he's open to Ukraine launching more attacks on Russia as the White House seeks to pressure President Putin into a meeting with Ukraine's leader. In a Truth Social post, Trump wrote that it's hard to win a war without attacking the invader's country. Bloomberg's John Herskovitz is with us, and President Trump really trying to bring into fruition the Putin-Zelensky meeting, but will it happen, I guess?
Yeah, we have 2 of the 3 parties say that they're interested in it. Of course, Trump is pushing for this to happen. Zelensky is saying that it can happen. He's looking for a neutral site somewhere in Europe. But there's Russia. Russia has shown no inclination towards meeting Zelensky. They have continued their hardline stances. And it just seems like while the White House has optimism, Zelensky is open, there's no indication that Putin is ready to sit down for direct talks with the Ukrainian leader for a ceasefire, let alone a peace deal.
Anything else on security guarantees at this point for Ukraine?
Sure. We have some talk going on now between Ukraine and European leaders looking for an Article 5 NATO type of arrangement that would put in some sort of collective defense that would help Ukraine get some European boots on the ground. It could get some European boots on the ground. And this is something that Russia has objected to. And we've seen the foreign minister of Russia, Sergei Lavrov, repeat some of these maximalist demands that is seen for Ukraine. It doesn't want European troops in Ukraine. It doesn't want any European protection for Ukraine. So while these talks go on, and these are key for any agreement, Zelensky has said that we must have some real security guarantees if we're going to have a ceasefire or a peace deal. Of course, Russia isn't moving towards any of these and has shown stern objections to what's going on.
Yeah, and at the same time, John, Russia is continuing these strikes on Ukraine. What are we seeing from the Russian side?
Yeah, we've seen massive drone and missile strikes that have happened while these talks are going on. This has kind of been par for the course for Putin, that while Trump has pressured for a ceasefire, Putin has responded with more attacks on more parts of Ukraine. We saw some attacks overnight on Ukraine. So it just shows that while there is a push for some sort of movement towards a ceasefire or some sort of peace deal, that Russia is responding by increasing its assaults on Ukraine, trying to get more territory, and launching more drone and missile strikes. It just kind of shows that Russia is much more interested now in increasing the military pressure and the attacks than sitting down.
Bloomberg's John Herskovitz here with the latest on that negotiation over Ukraine. But we continue to watch, of course, the futures market in Europe at a time when we saw a little bit of a waiver in the overnight session. We had 3 sessions of gains already for European stocks, but investors were really trying to parse the data, especially on euro area business activity. You can see the euro holding at that 116 level. We're also getting a bit more progress on the U.S. and the European Union also taking steps to formalize their trade deal. We're talking about detailed plans on reducing tariffs on European car makers within weeks. We have more ahead. This is Bloomberg.
Let's take a look at how markets are faring as the countdown continues to Powell's speech at Jackson Hole. That risk-off was quite pronounced in the U.S. session the past couple of days. We're seeing a bit of a reversal in the Goolsbee, and this is driven by some of the chip-related stocks, including Samsung and SK Hynix, which is also interesting against the backdrop of Nvidia earnings coming out next week, but also how the chip giant has told some of its suppliers to suspend anything related to the H20 chip production. Rest of the region looking quite cautious ahead of Jackson Hole. Now, speaking of tech, smartphone giant Xiaomi has succeeded where Apple failed by launching its own electric car. The dramatic pivot has helped the Chinese company gain some $120 billion in market value over the past year. Bloomberg Originals has been looking at Xiaomi's push into the EV sector. Here's a preview.
What tech giant has a connected ecosystem of products, a devoted fan base, and is constantly innovating? If you're in the US, you may say Apple, but in China, it's Xiaomi.
It's this consistent marketing to the younger consumers in China that has cultivated kind of a cult following.
For many consumers in China, Xiaomi is Apple, is Tesla, is Google.
Now, Xiaomi has managed what Apple failed to do: build a car.
Xiaomi shares have touched a record high after strong initial orders for its new $35,000 SUV.
So within 3 years, they managed to set up this very complicated supply chain in China and essentially churn out these incredibly popular cars.
Profits have jumped as customers rush to the company's latest offerings. But succeeding in the world's most crowded EV market isn't easy.
Competition is really fierce right now.
Growth will mean turning Xiaomi into a global brand. And this is no easy task when the world's biggest economy is effectively off limits because of trade barriers. Yet, Chinese companies are already tapping markets beyond the US. So, is Xiaomi on easy street? Or will it be a bumpy road to success?
Subscribers can watch that documentary in full right now on the terminal and on Bloomberg.com, and it'll be up on the Bloomberg Originals YouTube channel a little later. Stick around for Bloomberg Tech Asia as we explore how companies are pushing the boundaries of innovation for humanoid robots. That's coming up in a few minutes. In the meantime, quick look at how Japanese assets are faring.